All right, everyone, welcome back to the Jason Gray Show. Please like and subscribe. Let's go ahead and talk about this week's indicators. We have the CPI report that rolled out today. We have the PPI report out tomorrow. We have the Federal Reserve meeting tomorrow, and we have retail sales. And a lot of things are happening within these reports. I'll do this video really quick so you can get some insight to give to your clients. But let's talk about the CPI report first. CPI report came in right where Wall Street was anticipating. It was a really, really good report. And inside there's three major things I want to point out. One, energy costs dropped dramatically. Oil prices have went down, so that cost went down dramatically. Now, the two things that are killing us, that's killed us the last few months, and we've talked about this a few times, is used car sales still showing really high, even though the Manheim report, and if you don't know what the Manheim report is, it's a report that shows used car sales going across the auction blocks for dealers. And that is actually, if you look at real-time data, shows that used car prices are going down. But again, the Federal Reserve has these lagging indicators, and unfortunately they're showing used car prices going up right now. This will catch up to us the next 2 months. So we'll see actually positive reports on the CPI reports for the next 2 months. All right, so then let's go ahead and talk about the other piece of the puzzle, this lagging indicator of the housing expense. And I know we've talked about this bell curve that we're finally trying to get there, but that old data is still in these reports. So if you were to remove the used car piece and the housing expense piece, this number would have been great. And that's why you're seeing the stock market rally today, is because when they dig into these numbers, these are smart people, everyone, right? They look into the data. They don't look at like the headline numbers. They dig deep into all these different categories that's happening within the CPI report. And that's why the stock market's doing well. Same thing with mortgage-backed securities is doing well, talking right now. Now, in going forward, we really think mortgage rates are still going to continue to go down at the end of this year. And I'm going to explain to you why. Next thing that's going to come out is the PPI report tomorrow. Should come in at market what they're anticipating. That's the wholesale prices for the manufacturers. But let's talk about the Federal Reserve's meeting tomorrow. They have a meeting tomorrow at 11 o'clock where they're going to announce what they're going to do with the federal funds rate. They should take a pause. And what I mean by a pause is they're not going to increase or decrease interest rates. They're going to leave them exactly the same. Now, the reason why they're going to do that is because I think they need to give themselves some time to figure out, with all their rate increases that they have done over the last 10 meetings, by the way, they went from 0 to 5% in 10 meetings. They're sitting back and saying, okay, let's see how this affects the economy going forward. And so, in my personal opinion, I think mortgage rates still are going to go down at the end of the year. The reason behind that is I think they went too far too fast, and these year-over-year numbers are going to replace last year's numbers with these really, really high numbers we had with these lower numbers, and it's going to make it look like the economy is slowing down. But remember, when you replace the year-over-year numbers, we still have inflation baked into the system because that number went up. So they're going to see a pretty big downward turn, and when they see that big downward turn, they're going to have to pivot. And what I mean by pivot is they're going to have to start lowering interest rates. And this will help the 10-year Treasury market and help mortgage-backed securities out when they start seeing the Federal Reserve freak out a little bit, and you start seeing them reduce interest rates. Now, when they reduce interest rates, that doesn't necessarily take mortgage rates down. It's the comments or how the economy is doing at the time that brings rates down. What the Federal Reserve is in control of on the federal funds rate is interest rates for car loans, credit cards, and home equity lines of credit. Mortgage-backed securities are traded on a different market. The Federal Reserve does not have any control over it, but their comments and their stance and their policy affects mortgage rates. So this is some really good information to give back to your clients so you're educated about it. Of course, I want to relay this information. It's really not your responsibility to relay this information to your clients. But when I'm talking to your clients, this is part of the conversations that we have. Why are we going into a situation on paying no points on a purchase right now? Why do we want to not waste that money? Because if you pay a point, let's make an example. If you get a $600,000 loan amount and your clients charge 1 point, that's $6,000. And maybe they gained 0.25% in interest rate. But the break-even point on that money is about 4 years. And if I'm right, where I think mortgage rates are going to come down in the next 3, 6, 12, 18 months from now, we would just be burning $100 bills in just a fire pit. right? It would have been wasted money. So what I'm telling all the clients, if I can get them into a situation where they're paying no points, and there are some situations where they have to pay points because of credit scores, situations, investment properties, things like that that I can't control, where they do unfortunately have to charge some points. But if at all possible, we want to charge them no points. And when rates drop, then refinance them right away. We can refinance them every 6 months. There's nothing in writing that says we can't refinance them earlier. We're just trying to break even on our money by originating another new loan. So anyways, hopefully this is a good, useful tool for you so you know my strategies for your clients going forward. I really think mortgage rates will trend towards, down into the mid-5s by the end of the year. So please like and subscribe, and I'll talk to you soon. Bye-bye.